Good. Great. Yeah. So welcome everyone to a very interesting session. And I think we'll start with Deepti. So floor is yours.
All right. So I'll share my screen. Can everyone see the deck of slides? Okay. All right. Great. So without much ado, I'll just jump right in because we have limited time. So this paper basically is a re-examination of existing evidence on what was the impact of the nationwide rollout of e-FMS, which is an e-governance initiative within MGNREGA. What is MGNREGA? It's the flagship program, employment guarantee program in India. It was started in 2005. It basically guarantees 100 days of work to any rural household that demands it. So we re-examined this evidence that that was put forth in 2020, and we basically find that there are the estimates that the authors come up with are biased. So we present what are the sources of bias, and it's useful to know that in and of itself, because this method that the authors use is very often used in public policy. So it's useful to flag what are the problems here. And then more recently, we have tried to present new estimates to answer this question ourselves, knowing that the existing evidence is not right. So let me jump right in. Okay. So the context I already said, but briefly to highlight, there is concern that there is a lot of leakage from within the MGNREGA because of corruption. And this initiative was started in 2012 by the national government. It's called Electronics Fund Management System, or e-FMS for short. And the idea was, by introducing this, there would be greater transparency in fund flow, and this would perhaps reduce corruption and lead to savings to the exchequer.
Sorry, just briefly, Deepti, I don't think we can see any advancement of the slides. At least
No,
I'm still seeing your title page.
Yeah, it's advancing at my end. So what should I do? Okay, let me stop and share again, and let's see what happens. Okay. What slide do you see?
Yes, perfect now. Yes.
Okay, and let me move it and see if it moves at your end. Is it moving at your end?
No.
No.
So I'm still on the e-FMS intervention slide 3.
Can you move it below? Yes.
Now it's moving?
No, move one more.
No.
Yes, now we see
it's
it.
now moving.
Yeah.
It's moving.
Okay, so this is not the slide mode, but maybe I'll just keep it this way because at least the slides are moving. Yeah. Okay.
Sounds good.
Okay. So they're moving now? Yeah. All right, great. Yeah. So what is e-FMS essentially? What did it do? What is the intervention? It basically changed the way in which funds were transferred between the central government and the lowest implementing agency of the MGNREGA, which is called the Gram Panchayat at the village level, or group of villages, essentially. What it did was, earlier, MGNREGA funds, which were a large part of which was used for wage payments, used to happen, were given to the Gram Panchayat in advance of the work being initiated, whereas post e-FMS, which is today, the funds come soon after the work within the program has been undertaken. So that's one big change. So that's why it said it moved from advance payment to just-in-time payments. And the basic idea was, by doing this, there would be a shorter time gap between work having been done and the social audit happening. And this might basically improve efficiency by a greater chance of detecting fraud. So this was the broad idea behind e-FMS. And the other big change was that the funds would now directly go into the accounts of the workers instead of first going to the Gram Panchayat account and then to the workers. Yeah. So what is the evidence that we re-examine? So in 2020, Banerjee and co-authors published this paper, which was about the e-governance initiative, e-FMS. And a large part of the paper was essentially about a randomized control trial in the state of Bihar. Now, what I want to highlight is that the e-FMS that they study in Bihar is slightly different from the e-FMS that was rolled out nationally. So that needs to be kept in mind. So it would not be correct to take Bihar as the direct evidence of, on a smaller scale, of the e-FMS that was rolled out nationally. So that needs to be kept in mind. The one thing that was the same between the two versions of e-FMS was that it moved from advance payments to just in time, but there were some differences, including the fact that in Bihar e-FMS, the funds would continue to go to the Gram Panchayat first and not directly to the workers. And also there were some data entry regulations that were different. In Bihar, the data had to be entered twice, whereas in the national version of the e-FMS, it's to be entered only once. Keeping these in mind, what they found in the RCT, in the randomized trial in Bihar, was that they found the rollout of the e-FMS resulted in a 24% decline in wage expenditures. So that's a huge saving if it's coming purely from preventing leakages. So that's big. That's a big result. And they provide auxiliary evidence to suggest that this saving is coming from a reduction in leakages. Then they have a second part of their paper, which is what we focus on and what we re-examine, which is to do with the national rollout of e-FMS. And then they use a two-way fixed effects model to essentially establish that national rollout of the e-FMS resulted in a 19% reduction in wage expenditure. So it's this that we are revisiting in our paper. So what are the objectives? So we re-examine their evidence. We replicate their results for labor expenditure and material expenditure, and we add an additional variable, which is person days worked, which they do not have when they examine the evidence at scale. We apply what is called the Goodman-Bacon decomposition to disentangle what's basically happening behind the scenes of the two-way fixed effects. So this gives you a pictorial picture of the constituents of the different estimates that go into making the two-way fixed effects estimate. And then this is not fully finished, but I'll show you the preliminary results that we have. We try to put forward our own estimates of what the impact is. Okay. So what's our approach? So this is the big picture of what I'll show you. So first, we'll closely examine what are the assumptions which are needed for two-way fixed effects to be a valid strategy for identification. So it's not that one cannot ever use two-way fixed effects today. It's just that one is more clear about what are the assumptions that are needed for this method to be valid. So we look into that. Then we will. Then I'll show you our replications of Banerjee et al.'s results. Then we will use the Goodman-Bacon decomposition to disentangle the two-way fixed effects estimate. Then we will focus on what are called the legitimate comparisons within the two-way fixed effects. Our initial approach towards this work was essentially stopping there and trying to unearth heterogeneity that we may find in the impacts. But then as we started re-examining it, we realized that even these constituent legitimate comparisons might not be valid because of the good old parallel trends assumption not holding good. And that was a new twist which we hadn't anticipated when we began this work. So I'll highlight what is the importance of parallel trends, which is pretty well known, but it's useful to emphasize this because sometimes it might get lost when people start using fancy methods like Santana, Callaway, etc. And then finally, if time permits, I will cover the new method that we are proposing to use. Okay. All right. So this is the basic rudimentary workhorse two-way fixed effects model. The D is for district, T is for time. So we essentially have an outcome variable Y, and we have district fixed effects, eta D, and time fixed effects, mu T. And then you have the intervention, which in our case is e-FMS. And this beta coefficient is the one which has been given causal interpretation in the past and now which is being questioned by new literature. So Goodman-Bacon shows that this beta that you saw over there is basically composed of multiple small betas. It's a weighted average of multiple small betas that come from 2x2 comparisons. By 2x2, I mean 2 groups over 2 time periods. And one set of comparisons they call early versus late, and the other set they call late versus early. Now, essentially what this is, that early versus late is basically, imagine a scenario where the intervention happens on different groups or subpopulations at different points in time. So early versus late would be a comparison, which is getting at the effect by comparing some group that got treated early with a group that has yet to be treated. And the group that's yet to be treated acts as the counterfactual. And late versus early is the opposite. Here, the treated group is the group that got treated later in time. And the early group, which has already been treated, acts as its counterfactual. And this is problematic sometimes. So the late versus early comparisons are problematic sometimes. And I'll try to explain when they're problematic and when they're not. Now, for the two-way fixed effects estimate to be credible, again, I want to say that there is still occasion when it can be credible. 2 things need to happen essentially. One is that the different components, when you look at them, you must check that parallel trends holds for all the constituent components of the two-way fixed effects estimate. So all the 2x2 comparisons, that's one. And the other is you need that the nature of the effect of the intervention is such that it's a one-time level shift. It cannot have any time varying component as part of the effect. And that's what's, I think, the new bit that Goodman-Bacon and others emphasize. So this is in terms of pictures, if I can quickly highlight what's the importance of both these assumptions. So this is a simple hypothetical example where there are 2 groups. They are getting treated at 2 different times, T1 and T2. If you see the x-axis, there's T1, the early group, which is the yellow group that gets treated at time T1. And then there's the blue group that gets treated later at time T2. And in this picture, basically, the way I've drawn it, both assumptions hold good. Parallel trends holds good, and it's the nature of the effect is a one-time level shift. So how do you see that? If you look at the pre-treatment period, here you see the trends are parallel. This is the evolution of the outcome. And when you see for this group T1, the yellow group, when it gets treated, it's a one-time level shift. Similarly, for the blue group, it's a one-time level shift, and that's what you have. And you're essentially able to build the counterfactuals, which are these dashed yellow and dashed blue lines. But, you can pictorially see it. You can just plot it by looking at this trend here, the counterfactual for yellow, and you can plot this counterfactual by looking at this evolution here. Okay. Now, what happens when parallel trends continues to hold, but the nature of the effect is not a one-time level shift, but it's a change in it also includes a change in the time trend. So now look at this picture, parallel trends is still holding, okay? But instead of a one-time level shift, I now have a time trend in my effect. And similarly for the blue one. Now, here is where something interesting happens. For the yellow case, which is the earliest treated group in this example, you can still make the counterfactual because you still have this blue evolution, parallel trends holds, and you can make the counterfactual. Whereas for the later treated group, the blue one, you cannot make the counterfactual anymore because this has a time trend, which is part of the effect of the intervention in it. So you can't use this observed yellow evolution to make this counterfactual. And that's, that's the insight that essentially Santana, Callaway, and Abraham et al. Use to build their new methods. They rely on what they call the legitimate comparisons only and disregard these to build their new estimates. But again, one has to remember to do Santana, Callaway, and sorry, there's a problem with the way it moves. To do Santana, Callaway, etc., you still need the parallel trends assumption. You can't do without that. And here is a graph which shows what happens if parallel trends breaks. If parallel trends gets violated, then you can't build any counterfactual. The whole thing breaks down. And essentially what the bottom line is for the e-FMS e-FMS case, the parallel trends doesn't hold for the constituent components in most cases.
About 5 more minutes.
Okay, so this is the replication of the results. I'm not going to pause there. This is a picture of the constituent 2x2 components. The green ones are the legitimate early versus late comparisons, and the red ones are the late versus early. So now one approach would have been just focus on the early versus late. This is a Goodman-Bacon picture of it. So now here, when we focus on just the legitimate ones, this is what we see. And you can see that there are still some highly negative reductions in labor expenditure. The output here is labor expenditure that you see when you focus on just the legitimate ones. What I mean by alternative specification is using district specific time trends in it. Okay, here we lose, one could say we lose power, and so we are getting, we're not getting significance, but also the magnitudes are all over the place. Some are negative, some are positive. But again, you can't believe this unless you see if parallel trends holds. And when we do that, we find only the blue ones are the instances where parallel trends holds. Now, the other thing which I want to highlight, and because we're running short of time, I'll do it quickly, is this, what Banerjee et al. Want to say is that they put district-specific time trends into their estimation, the main estimation, and that solves the problem of parallel trends. One, we revisit the placebo robustness check with the district-specific time trends and find that still parallel trends don't hold. But even if they did, what I want to highlight here, which is something that the profession doesn't always recognize, is that throwing in district-specific trends has the same problem as two-way fixed effects, which is the district-specific trends are being estimated using partly post-period data. So that trend is a mix of pure trends, pre-period and post-period. So it suffers from the same problem that Santana, Callaway, etc. are trying to highlight. To essentially get over that quickly in a minute, what we do is we use only pre-period data, and we use trends, district and time trends and interactions to predict what the counterfactuals would be. And then we, in this new method, we basically put those predictions on the right-hand side, and then we put an intervention indicator to get what the estimate is. So this beta nu now doesn't suffer from the basic problems which happen in two-way fixed effects or by simply throwing district-specific time trends. It doesn't suffer from this contamination by post-treatment controls. Don't pay attention to this because we still have to correct the standard errors because we're using estimated values on the right-hand side. We haven't done that. This is work in progress. Last two slides. So summing up, essentially the two-way fixed effects estimates are biased. And the source of the bias is coming not only from using the non-legitimate comparisons, but even when you focus on only the legitimate 2x2 comparisons, parallel trends doesn't hold, and so you can't use that identification either. So then you have to look for new sources of variation which are clean. We are making an attempt to do that, and where our results are kind of leading us is that, in addition, substantially coming to the e-FMS bit of it, we are finding that there is suggestive evidence of labor expenditure, but there is also suggestive evidence, and this is troubling, of real employment falling down. And so, if on further exploration, we find that there is clear evidence of real employment also taking a hit, then that's something that policymakers need to know, that e-FMS is not all hunky-dory. It's also affecting real employment under the scheme. And I'll stop there.
Perfect. Thank you so much, Deepti. Yeah, so we have a couple of minutes for questions and discussion. I don't know whether anyone has a question. Otherwise, I'll maybe start us off here and use my privilege here as chair. So as I think, Deepti, I've told you before, I really like this paper. I think this is really, really helpful, especially for everyone who works on the NREGA part of the literature, because this is clearly highly policy relevant, right? We need to know, are sort of these digitization changes here really making a difference. One thing that I was thinking about, which I'm never sure what the prior is, but I think you outlined very rightfully, right, the case of, oh, here's the problem with two-way fixed effects, and then here is the correction. My sense is that a lot of people that have tried sort of implementing then those alternatives tend to find that it doesn't matter nearly as much as people might have feared initially. So I've seen now a lot of presentations that seem to suggest, well, yeah, maybe your results get a bit attenuated if you correct for the bias, but more or less the patterns hold up. And so I think yours is a really nice example of where the difference is important, or where getting into what exactly are these comparisons seems to really matter. And so I think potentially that would be something you could play up a bit more, depending on what people's priors are. The other thing that I was thinking about, and this maybe we'll get into the question, is I don't know whether you're aware of this paper by John Gardner, who's also along the growing list of these people suggesting new approaches, which sounds fairly similar to the new method you're proposing. And so I've implemented that in another paper of mine, but it sounds essentially very similar, where you're trying to estimate both year and state, typically is a typical example, year and state fixed effects, using just the untreated observations, and then correcting standard errors, right, in sort of almost like a two-step process, like with an IV. So if you haven't had a look at that, it might be interesting. And there's this other paper by Spies et al., I think, which is sort of the alternative. Might be interesting to look at those. But yeah, as I said, I really like this paper.
I'll send you a message asking me to send both these references.
Yeah, definitely.
So on the fact that this is an interesting example of using the decomposition, because it gives you essentially qualitative differences across 2x2 comparisons. So that was our initial approach. So I agree that it's interesting, and it might be useful to characterize those differences, where you get increases in expenditure and decreases, and why do you get those? So that we'll keep in mind. The other thing, Laura, since you've exchanged this useful information on other alternative methods, is also this not much talked about method by Mora and Reggio, which basically uses higher order assumptions. So think of double difference, and then triple, and so on and so on, but not in the geography dimension, in the time dimension. Essentially, when you do triple difference, you think about the geography dimension, but this is in the time dimension. So that's, I don't know why, but it hasn't received, even though it's been published at the same time along with these other papers, it hasn't received as much recognition by the community. So that's something which we want to explore. And the other thing is Santana Callaway. I'm just averse to using black box canned programs, so that's why I'm not showing you the results until I'm clear about it and my co-authors are clear about it.
Yeah, and it's not straightforward. So I should say too, Callaway brand is my direct office neighbor. And so he also has an aversion to status. I think there's now like a user written Stata command as well, but traditionally it was just in R because he feels very strongly that R should be the program to use. But it's not the easiest to implement. So I fully agree that it makes sense to understand what exactly is it doing, because they have a lot of bells and whistles that you can either switch on or switch off, things like the doubly robust standard errors, and do you want to do matching, propensity score matching in the first stage or not. So but yeah, if you have questions on those, I think Brand has been really, really helpful at answering people's questions as they implement his code.
Yeah. All right.
Excellent. Do we have other questions or comments?
I had one.
Yes.
So, because actually I've sort of recently started reading up these papers for another paper that we're writing. And one thing that I have sort of found a bit intriguing so far in the Sunan Abraham and these approaches, as you like in general, there is, when the parallel trends don't hold, none of them really talk about anything, right? Like I think in your case, the case that you're trying to present is when the parallel trends don't hold. I think what I have understood of their papers is that they've assumed that if parallel trends hold in the clean groups, then XYZ holds, right? But what I assume you're trying to say is that when your bottom line assumption doesn't hold, then what is the way out? Which is that correct? If
So the first part of it is correct, that all these other methods assume that the parallel trends holds. So Santana, Calvé, Abraham et al., they all assume that parallel trends holds. What I want, my remark, whatever I made during the presentation, was just to highlight to the community that that's important. While they don't focus on it, one must recognize that you need that. What we are doing is we are investigating the parallel trends and only taking variation from the bits where parallel trends holds. So if parallel trends breaks, we also can't make much progress. I need to think, I need to think if the newer methods can get us somewhere in the absence of parallel trends, but I'm not very clear that they do. I need to think a little more about that.
But when you're trying to put in the district time trends and trying to predict, aren't you trying to bring some of these non-parallel trends? Like,
so yes, but on the district specific time trends, just throwing district specific time trends
that doesn't help.
It doesn't help because you're convoluting pre-trends with post-trends, and it's complete. It's not sensible. So what then we are doing is we're going back and using only pre-treated data, and we are using almost trying to make the model saturated. So I think we are getting away from the need for parallel trends, but I'm not thought it through. So I actually value your question. I'm going to think about that. We're using only pre-data to make the prediction and then use that as a control. But thanks for your question. That makes me think we should think a little more on what we're doing. Thank you.
Time for probably one more short question, if anyone has any.
Well, quick question.
Yeah.
So I guess you're finding, Deepti, that this new electronic transfer did not reduce corruption. Is that the idea?
It's inconclusive, but so what the earlier paper concludes is that they find a lot of a heavy reduction in labor expenditure or wage payments, and they find a lot of suggestive evidence to point to the fact that this is happening because of reduced corruption. What we are finding, which is not yet conclusive, but what the data seems to suggest is that, yes, there is a decrease in labor expenditure, but simultaneously, there seems to also be a decrease in employment levels, which cannot be completely explained by reduction in corruption. The magnitude is too much to completely attribute that to a reduction in corruption. Now, if these results are correct, that both the things are happening and the reduction in employment cannot be explained completely by a reduction in corruption, then it's a major policy result.
Oh. Yeah, and if everyone stays tuned for my presentation. So we're looking at a different policy change, but we actually find that at least in Uttarakhand, doesn't look like e-FMS had much of an effect at all. So that gels with sort of the initial findings that Deepti has, which contradicts very much the positive spin that Banerjee et al. put on their results. Great, so then we'll move on. So next up we have Kanika, so take it away.
Can everyone see my screen?
Mm-hmm.
Yeah.
Hi. Thanks for the invitation, Laura, to be a part of this session. It's glad to be presenting this work. It's very new work, so feedback would really be helpful here. And it's joint work with Nirupama at CAFRAL and with Riddhi at Ashoka. And the question that we are trying to look at in this paper is largely motivated by this entire literature, which has shown that imperfections in the credit market, financial frictions lead to differences in productivity across firms and hence have implications for overall economic growth, as well as inequality across firms. And in this context, papers have also shown that it's the smaller firms which tend to be more likely to actually face these credit constraints, and that's largely because they don't have enough collateral. Lenders may not know enough about them because they're smaller firms. Monitoring costs can also be higher for smaller firms. And at the same time, these are the firms which actually have a higher return to capital. So these are the firms which probably can bring you more bang for the buck. So the question that this paper is trying to ask is if increased physical proximity to financial institutions like banks can increase the credit and investment of taking these smaller firms. And the channels that we're going to examine in this paper is if it becomes easier to acquire information or easier to monitor these smaller firms when these financial institutions are physically more proximate to these smaller firms. The policy change that we exploit in this paper to answer this question is in India. India, we feel, is a good context to even study this question, largely because of three reasons. One is that we know that India, the capital markets in India are not perfect. So these firms, in fact, a lot of firms face financial frictions when they want to access loans, etc., to be able to fund themselves. Second, bank credit remains to be one of the foremost sources of loans in India for firms. And at the same time, India is a country which has a large number of these small-sized firms. So in a way, can these policies by the government actually enable these firms to be able to access capital and hence make further investments is the question. And the branch bank expansion policy that we study in this paper came about in 2005. Under this policy, what the RBI had done is it had classified certain districts as underbanked. If these districts had the bank branch density, which is bank branches per capita in these districts, was less than the national average in the country. And the incentive that was given to the private banks was that you will be favorably considered in other areas if you open branches in these underbanked districts. So the fact that a national average was basically used to classify districts as underbanked versus not underbanked is something that one can use to be able to undertake causal estimation of the impact of this program on capital and credit offtake of these smaller firms. Broadly, just to give you an overview of results that we're finding so far. One is that this policy indeed, it did lead to an increase in the private bank branches in the underbanked districts. And over this 4-year period between 2006 and 2010, about 6 to 8 additional private bank branches were opened in the underbanked districts. What we find is that because of additional bank branches opening in these areas, there was an increased credit disbursement in these areas, both for manufacturing as well as agriculture. There was also an increase in the number of private bank loan officers in these districts. We also find an increase in capital expenditures by manufacturing firms, about 4 percentage point increase in these expenditures. And moreover, this increase is largely coming from the smaller firms, especially the small and the younger firms, which are probably more capital constrained. Even the small scale industry segments are the ones which are gaining more because of this increased access to capital. And these are the firms which also see a higher credit growth. So in a way, it's a credit which is leading to this increased capital expenditure by these smaller firms. In terms of the mechanisms, there are 3 mechanisms that we largely probe so far. One is we look at the proximity to the lenders. We find that there is some reduction in distance between the private bank, the average distance between the private banks and the center of a district, which probably says that these bank branches are more dispersed now. They're not just in the central location of the district, making them more accessible to the smaller firms, which are also likely to locate away from the center or the main sort of the hub of the district. Second, we find that the lender specialization matters. So not all private banks are able to make this difference or increase access to capital to these smaller firms. It's the banks which have had a previous history of lending to smaller manufacturing units who are actually able to make, which are actually able to bring about this difference that we see. Lastly, our results show that whatever things we find on the smaller firms cannot just be explained by an overall, because we know when there is increased access to credit, there will be an increased aggregate demand overall, right, in the district. So it can't only be explained by aggregate demand because we find effects of both tradable as well as non-tradable sectors. And at the same time, it was not that this increased competition by more banks led to decreased rates or at least formal rates of lending for these firms. So we don't find evidence for that either. So largely, we find that it's the lender proximity and the lender specialization which seems to be driving the results that we are finding in this context. Okay. So we broadly contribute to 2 literatures here. One is examining the effect of financial deepening on various firm level outcomes. I think there's only one paper here which has sort of looked at what are the differences in the effects by the size of the firm. And that's by Fakhjams and Chinlin in 2013, in which they find that for Morocco, it's the smaller firms in the high growth sectors which see an increase. However, what they're exploiting is, it's just an overall, year by year changes in the number of bank branches in different areas. So it's not completely causal in that sense, because it can be endogenous where these bank branches are placing themselves. Apart from this, no other paper has really looked at by how these impacts happen by the size of the firms, or what the distributional implications of access to credit are, especially in developing country settings. We also contributed to literature which has shown that capital matters for smaller size firms, and because they're constrained for this capital, they are able to grow less. And our paper shows that if you alleviate the credit constraint by making them physically more proximate, then it can overcome this lack of capital for these smaller firms, which the literature has really focused on a lot. So just to briefly give you a bit more detail about this policy intervention, because we're going to create a running variable out of the difference between the bank branch density in a given district and the national bank branch density at all over India level. We use the census 2001 because that is what the government also used to be able to arrive at this bank branch density. And what we find is that if we use 2001 census, almost all districts comply with what the government rule book says, except with the exception of 9 districts. So we use a sharp RDN design in which we drop these 9 districts. If we include them, then we try the fuzzy RDD, and that also goes through. But presenting the results here primarily for the sharp RAD. So this is the running variable, and around the threshold of 0, we have enough density, basically to be able to exploit. What are the districts just below threshold and the districts just above the threshold. In a bandwidth of about 15, there are about 230 districts that overall lie around the threshold. So there is enough power for us to exploit in the running variable. At the firm level, we use the annual survey of industries as the main data. This is a manufacturing establishment level data in which there is data on capital, fixed assets, workers, outputs, as well as the loans that these firms have taken. Now, ASI doesn't give district identifiers for all the rounds. They are available till 2009. And panel identifiers are available till at least 2014, I think. We're using in this period of 10 years, that is our primary period of interest. There are about 17,000 establishments in the data. We deflate everything that we show you in terms of nominal, in terms of value to the 2011 rupees, as well as winterize these variables because they have a lot of outliers at the top 1% on either side. Our primary outcome of interest is the capital expenditure. Here we've taken the difference between the opening and the closing assets of a firm and divided that by the average assets of that particular firm, since we're interested in the capital expenditure. And here we, define these assets in multiple ways, plant and machinery, etc. But our results remain pretty robust, as we'll see. We also look at what is the effect on loan growth, output, and workers of these firms. The other data sets that we use to be able to merge with the SI are the basic statistical returns of the RBI, as well as the NSS employment and unemployment survey for the controls. Let me just skip this slide in the interest of time. This is the main empirical strategy in which we are looking at firm I in district D in year D. We have the establishment and the industry year fixed effects. We control for the interactions of the running variable with a post and underbank because we are not using a simple cross-sectional RDD design. We're using a difference in discontinuity where we can actually exploit the panel structure of the data. So we're looking at changes over time around the discontinuity, essentially. And then we also have a bunch of district and firm-specific covariates. Even if we drop them, our results don't really change. In our main set of regressions, we are clustering the standard errors by district and industry, but we also cluster them just at the district level. And in the main specification, we use 15 as the bandwidth, but we again show to a multiple choices of bandwidths and sort of things hold. Our main coefficient of interest here is beta, which is the effect of being underbanked on the change in outcomes of a firm. But before going to the firm level regressions, what I will also show you is what is happening at the banking level in a given district. So here everything is just collapsed at the district level because we have the number of private bank branches as well as the amount of bank credit that's dispersed at the district level, because this is the RBI data and that's only available at the district level, just to show you that the first stage really works. And that's when we go to the firm level outcomes after we've looked at that there was an offtake in overall credit as well as an increase in the number of private bank branches. So in terms of the number of additional private bank branch openings, as I said, there was an average of 8, between 5 to 8, an average of 6, and between 5 to 8 in different specifications. Now, if you were to compare this to what Burgess and Pandey find for the social banking experiment, this is about 1/4 of the treatment effect of their paper. In addition, we do a number of placebo tests, and we find that there is no change in government bank branch openings. And there is no impact on private bank branch openings in the pre-period between 2001 and 2005. So these results tend to hold. And at the same time, there is an increased offtake in both farm credit as well as manufacturing credit, but there is no impact on credit by government banks on any of the major sectors. At the same time, there is an increased share of loan officers in these underbanked districts. First stages sort of seem to hold when we look at the RBI data. So given that we're able to sort of confirm that this policy was effective in a way and one can study it, that's when we go to the firm level data and try to see, okay, what was then the impact on these firms? And what we find is that there was, so here our dependent variable is the capital expenditures by the firms. All these specifications are just putting in different control variables. And we find that on an average, there's about 3 to 4% increase in the capital expenditures of an average firm if they were in an underbanked district. We then,
5 more minutes.
Sorry, 5 minutes. Okay.
Yes.
So we then, sort of look at the pre-trends as well to see if the assumptions hold really. And we find that there are no pre-trends, everything is insignificant, and there's an increase of take only after the program really comes into implementation. For both plant and machinery, which is the capital expenditure, as well as the credit growth at the firm level, both across a range of bandwidths. Let me just skip this. This is just robustness that we've done to a bunch of other alternative specifications. Now, directly coming into which are these firms which benefited more in terms of an increase in the capital expenditure. Here we find that we again take a triple difference specification here, which is again a difference in discontinuities kind of a specification, but we have an interaction with firm-specific indicators which we take from the pre-treatment period. So either it's a large firm or a small and young firm, etc. And what we find is that if we look at these heterogeneities, then the entire positive effect is basically being driven by smaller firms. So here we've broken the employment size by the different quartiles. And in the third specification, we've broken it by the age and the size of the firm. It's again the youngest and the smallest which are driving this entire positive impact. It's actually insignificant if you add these to the main coefficient of interest. Even the listed firms, so it's the unlisted firms or the smaller firms really which are gaining more from increased access to this credit from these more recently opened bank branches. So similarly, we find that this increase in capital expenditure is being explained by an increase in credit growth in these firms. It's an increase in credit, which is really sort of promoting or leading to this surge in capital expenditures by these smaller firms. So we then test for a bunch of mechanisms. So to test for physical proximity of lenders, now we don't have where these firms are located, but then what we have is location of these bank branches. We have the PIN codes. So we get the average distance of these bank branches to the city center, which is the centroid of a particular district. And then we see how this average distance has changed due to this policy coming into place. And what we find is that on an average, now with this policy coming into place, private bank branches are more likely to be located away. So the distance from the centroid of the district has sort of increased. So these new private bank branches are basically coming further away from the district headquarters when they're locating themselves. So in a way, and the next step that we're trying to do is using the prowess data and looking at these firms. Again, prowess is slightly large, but again, within the large firms, where are these smaller firms located? So that's the next step that we are going to do, hopefully, very soon. We look at what happens by a range of bank characteristics, whether it's the smaller private banks, whether it's the private banks, which on an average give smaller loans, or is it the banks which on an average lend to smaller enterprises? And what we find here is that the most important characteristic that really explains this increased disbursement of capital expenditures by these smaller firms is if the private banks that entered into a particular district already had experience of lending to smaller manufacturing firms. So that's the main characteristic that sort of really plays out in this analysis. We look at rate of interest impact. We don't find anything, so there is no decline in that. We look at borrower quality. Maybe the quality of borrowing has also increased apart from just increase in credit offtake. We again don't find any differential impact on the NPAs over time in underbanked and non-underbanked areas. So clearly that's not the channel either. We do find impact on aggregate demand, although we find that there is an impact both on tradable and non-tradable industries. So again, aggregate demand cannot be the only channel that's showing, due to which we find an increase in credit and capital expenditure offtake by these smaller firms. But just to see, okay, what are the general equilibrium impacts? This is the panel data we've seen firm by firm impacts. But overall, what happened to these districts, in which the bank branch expansion took place? So we now look at outcome at the industry level, where we also use the cross-section part of the ASI. And when we look at these outcomes, we find that because of access, that in these underbanked areas, there was not only an increase in capital expenditure, there was also an increase. It's not significant, but still a positive effect on output, slightly positive on workers. The entry of establishments increased, more importantly, in these underbanked regions. So I think that is sort of really highlighting that it probably had many other firms which were probably earlier, right, considered were not entering, were able to enter in these underbanked districts. So just to conclude quickly, I think the results that we found have sort of helped us understand that having physical proximity to banks matters, and especially it matters more for the smaller firms. And these smaller firms, if they've had a past history of dealing with these small borrowers, they're probably more likely to overcome these information constraints and perhaps focus more on these smaller borrowers, which also have a higher return to the capital. So yeah, let me just stop here and happy to receive comments, suggestions.
Great, thank you very much, Kanika. Any questions or comments?
Kanika, I think you found that government banks have no impact. Is that right? I mean, so what is the broad takeaway here?
So this policy was only for private banks. So government banks were not under the purview of this policy, basically. So they had no incentive to increase their. So in fact, that's a placebo test because they had no incentive to enter in these underbanked areas.
Why? Weren't they already there? Isn't that broad sort of government policy to put banks in underserved areas? I mean, isn't that,
Most likely, but not all of them would be present everywhere. So I'm sure there would be, one present in every area, maybe in every district. But since this policy didn't really apply to them, they had no incentive to change or to increase, I guess. But I agree with you, like these government banks are usually present in most of the areas. So many districts, in fact, didn't have any private bank branch to begin with before this policy started. And it's only, say, 5 years after the policy that we find that many of the districts now at least have one private bank branch.
I mean, I was just wondering if one of the messages of your paper is that private banks are more efficient or something,
Actually, I didn't motivate it like that, but that's what we also started thinking that, no, this is a very different context because it's just the private banks. So maybe if you had a similar policy for government banks, then you don't know what would have happened. But I agree with you. I'm like, probably we don't have enough meat to really, really hammer that point. But yes, we have toyed with the same thoughts that, this is a very specific context, unlike other contexts, where both the government and private banks probably increase, or only government banks increase, but this is pure private bank branch expansion. So maybe a lot of these results could just be driven by the fact that this policy was focused on the private branch, on the private banks who could then lend to more efficient or more productive firms, or where they could get higher returns to capital, basically.
Well, I guess a related comment. I mean, the interesting thing is, even if the private banks are more efficient, they still weren't doing this right before the policy. And so you probably don't have a chance really to get at this, but I think what would be really interesting if you could distinguish between where the private banks just miscalculating the benefits from moving into these more remote areas away from the district capital and so on, right? Or was the carrot, right, that they got, right, to really be incentivized to move into those areas, really what drove them to do it. But the second the carrot goes away, right, you might have all these branches shutting back down again, right, which I guess is the challenges that have come up in the microfinance literature, right, that you have a lot of these smaller providers, not all of them can break even. So then there's a question of, are the subsidies that you need to spend to keep them in business worth the benefit that they're creating for borrowers, right?
But I must mention here that even though they are smaller firms, but all of them are registered firms. So ASI is still primarily not, I wouldn't say it's like the bottom 5% of the distribution. No, it's not. In fact, it's not. If anything,
Absolutely.
it's like,
Yeah.
it begins after, say, 10%.
Mhm.
So you're still not, and with this, we still can't say what would be happening to the really small firms. Because all of these at some point of time were registered, so perhaps they've had some, some access to formal credit at some point of time. So I think that's a valid question. And though we're talking about small, but this is small with not really not like 1 or 2 or like 3 sides of workers mostly in most cases. So not that small either.
I guess, sorry, I guess
go ahead.
Laura's point, I guess, was that if there were profit opportunities in these areas before, why weren't these private banks going there, earlier on? Why do they have to wait for these incentives? So, I mean, so what is coming out here? I mean, are these private banks are clearly not subsidizing these
They're not
manufacturing
subsidizing,
firms?
so we don't find any reductions in cost in interest rates. Because of these private banks opening, there is no effect on that. Now, whether there was an increase in their profits, we can't measure that, unfortunately, because of course we don't have the data on the bank branch level, like profits, etc. We do have some information on them. But again, these would play out in the longer term. So I think one would have to think more about, how investments now, because these are going to play out in the books later on, right? Once they start getting these interest payments back. I think one needs to sort of carefully think about how to answer that question. I know it's a very important question, which Laura has asked, and I noted it down, but I don't know the answer to that question right now. So
I mean, I suggest that one of the reasons may have been that how do you get a manager to go and live in a remote place?
Mm.
The disincentive of that, you see, where's he going to get his kids educated and so on, to pack him off the boonies. That may be some, part of the story.
It could be. I'm like, I agree. Like I've had, bankers in my family, and no one wants to go to remote areas. So it's always a problem.
Kanika, if I may, my question was also similar to Laura's. I wanted a big picture clarification. What if all of this that you're finding is just policy driven, completely policy driven? It has to do with the incentives that the policy gave for these banks to open up where they are opening up, and they just want, back riding on those incentives, they're doing this. And if those incentives are gone, they wouldn't do this. So in which case, then then one isn't clear that it's this information story that you're trying to say it is, right? Because maybe it's just completely policy. And once you're there, then you have to do something. And so you lend.
No, but once you're there, then you can also just lend to the bigger players, right? Why? Or you just don't lend. In fact, there is no pressure.
So the policy directive didn't speak anything on who to lend
about their lending operation. So they could have lent anyway, as long as you just have a branch which is there. So the policy directive did not say anything about their lending or what operations they would do, or if they had some minimum amount that they had to disburse. Nothing on that front.
Okay.
But I can check again. But whatever I've read of the policy documents of the government, there was only just opening a bank branch in an underbank data. And I can also check with other sources.
Really interesting. Great. So then I guess we'll move on to Somdeep. And so take it away.
Sure. Thank you. Thank you, Laura, for organizing the session. Let me quickly see if I can share my screen. Can you see my screen?
Yes. Mm-hmm.
Yes.
Great. Thanks. All right. So this paper is joint work with Prashant Podar, who is an assistant professor at IIM Amritsar, and Shreya Mishra, who is a graduate student at IIM Lucknow. So let me dive into the paper directly. So, as per the United Nations, around 190 million women in the age group of 15 to 49 have an unmet need for family planning, right? So that's the basic premise we are starting out with. The incidence rate actually is much higher in low-income developing countries where compared to high-income developed nations. For instance, in India, the modern contraception usage is quite low. It's at about 56% as per the DHS 2019-20. So clearly, there exists a policy space to address this issue of unmet family planning, especially in the context of developing countries such as India. Now, majority of the policies on family planning usually focus on one of the following two types or genres of policy, if I may say so. First is supply side, right? So supply side measures of supply side birth control measures, such as removing the barriers to access to contraception, right? So there's a big body of literature which talks about all of these papers. The other, of course, is the demand side, where you sort of try to subsidize the cost of adopting contraception, right? And accordingly try to incentivize contraception adoption. Now, either way, these policies would have a significant financial burden on governments, particularly in developing countries. This is more so because, developing countries actually spend very small proportions on healthcare. For instance, India spends only 4% of its budget allocated to the National Health Mission on family planning, right? So because the spending is low, this further accentuates the problem. Like if you were to give out a program such as this, where the government has to bear the brunt of the expenses quite a lot, this becomes somewhat of an issue in terms of budget management, in terms of maintaining your fiscal as well. So in this paper, what we try to do is to understand this issue by looking at a policy experiment in India, which had both of these facets actually, right? So specifically, we focus on a program that was launched around 2011, which attempted to give out like home delivery of contraceptives, right? Now, this policy, as I said, had two competing features, and like some features of the demand side, some features of the supply side, which sort of makes this a unique and interesting policy. First, the policy focused on improving accessibility. How did they do it? Because it was providing doorstep access to contraceptives. So the contraceptives would be provided at the doorstep of the households. So if you think of access costs in the counterfactual, those are sort of removed, right? So that's the first facet. The second, however, is even though it improved accessibility, now it introduced a very small price of getting these contraceptives. So previously, they were available free of cost, but then you had to go somewhere to get it. But now you get them at your doorstep, but at a cost. Okay, so these are two competing elements. So due to these competing aspects, now you might think that the program could have, either increased or decreased fertility rate, depending on whether or not contraceptives are actually adopted. Another important feature of this policy, which is on the side that I'll also allude to every now and then, which is that this had this feature that the accredited social health workers, or ASHA workers as they're known in India, they will also have like this counseling component. So when they would give out these contraceptives, or when they would hold the camps in the localities, they would go out and inform a lot of these newly married households, newly married couples that these are the benefits from using contraception. This is where you can get them. This is what the price is, and so on and so forth. So there was this information component attached to it as well. So this pilot program essentially provides this unique setting for us to look at improved access as well as the results from an increase in price. And there's also this information nudge. So the contribution is, of course, that this is one of the early evidences of such a dichotomous government intervention on contraception usage and fertility. Now, why is this important? Because I sort of talked about the importance of the policy from the government's perspective, because it allows us to get a sense of the trade-offs involved, right? The trade-offs involved, which can potentially help to reduce the fiscal burden. So should you focus more on removing the barriers to access, or should you also be concerned about the budget problem it is associated with, and therefore think about introducing prices to sort of offset some of these costs that you might encounter. Okay, so let me quickly give you some policy background. So this was launched in 2011. So under this program, there are three types of contraceptives: condoms, OCPs, and ECPs, which would be provided to couples via doorstep delivery. Now the pricing was as follows, and you will figure out that these were very, very minor prices that were attached. So the condoms were priced at 1 rupee per pack of 3, OCPs 1 rupee per cycle, and ECPs were 2 rupees per unit. So these are like very marginal prices. And the rollout was at the district level. So there were 233 districts across 17 states in the country. The initiative was undertaken on a pilot basis with the aim to expand the policy later on to all districts at the time, but we'll just study the pilot. So we don't have any staggered or phased rollout that we have to worry about. So we'll just be looking at the pilot intervention and try to draw some inference based on that. Okay, it is important to note, however, that prior to the introduction, the districts that were chosen for this pilot intervention also had the regular policy that was still in place, which is that, from the primary healthcare centers or the PHCs, you could still get these contraceptives and free of cost. So you didn't have to pay anything for these, just that you had to make the trip to the PHC, to the nearest PHC, to try and get these contraceptives. Now, this practice was discontinued with the introduction of this new policy, only in these 233 districts, not in the other districts. So the other districts was business as usual. In these 233 pilot districts, the new policy would be introduced. Okay. So the initiative, again, as I said, relied heavily on the network of ASHA workers to promote the usage of contraceptives and home delivery, because the ASHA workers would be the ones who would, be going to the respective households for this home delivery purposes. Okay, so this is the map that I've drawn out, which shows the districts that were included in the pilot. And as you see that there appears to be some geographic variation here, because a lot of the southern part of India is not part of this. So it's mostly in the northern part of India. So we'll do some robustness later on as well, where we'll exclude the southern states and see if that affects our results. But right now, we're just looking at these 233 districts and the ones that are not included. Okay, so we'll use the IHDS and we'll use the panel of the IHDS. So we'll use both rounds of the IHDS, 2004-5 and 2011-12. Of course, all of us here are pretty familiar with the IHDS. It's a fairly representative household survey, very, very well used and widely used, right? So we'll just focus on the sample of the eligible ever married women on whom we have information on contraceptive usage, the types of contraception used, which were all collected as part of this survey, right? So our final sample would be around 73,000 women in the age group of 15 to 49. Now, let me talk a little bit about our ID strategy. So we'll use a standard diff here with the 233 pilot districts. They'd be considered as the treated districts, and the other districts would be part of the control districts. And we'll just use a pre-post sort of specification, because we have within state district variation as well. So it's not like we're just comparing across states, right? So very standard 2x2 diff sort of model. So this is the treatment assignment, just for expositional clarity. So, if you think of these HDC districts as the 233 pilot districts that were chosen, so they were the only ones who were eligible after August 2011, which is the post-policy period. All other districts were not eligible, and the HDC districts, of course, did not have this intervention before August 2011. So that's the diff model that we'll try to run. Okay, so this is going to be our specification, where we look at outcomes Y for individual I belonging to household H in district D at time T. We'll also include village fixed effects. We'll use this post dummy, but we'll use year fixed effects as well in many of our specifications. The coefficient of interest is essentially this beta, which is the interaction, which is basically the diff interaction, right? So it's the interaction between the treated dummy and the time dummy. Okay. We have a host of controls. I think in the interest of time, I'll probably skip the discussion. What I'll show you instead is a couple of parallel trends that we try to do. So this is the raw means that we've plotted. So these are basic summary statistics, basic averages of the treated and the control districts. There seems to be some change in the treated districts in the post policy, but I'll show you a better or more sophisticated version of this, which is this one, where we actually run it's like an event study. So we actually do the diff and diffs and we are able to do this because, we know the date of the survey. We know the day of the survey or the month of the survey that was conducted, and IHDS was conducted over 2 years, right? So we know whether the household was interviewed in 2004 or 5, or whether the household was interviewed in 11 or 12. and also the month, right? So that allows us to be able to do this sort of an analysis where we use 2004 as the excluded year and compare year-on-year different diffs for our main outcome, which is usage of contraception. And you see that it seems to be very much centered around 0 between 2004 and 5, but it sort of takes off in 11 and 12, particularly if you look at 2012. Okay. So now I'll show you some results. So this is the main result, which is on contraception usage. So this is like the extensive margin, like whether the household uses any form of contraception or not. Right? So I emphasize on the fact that any form of contraception. So as long as the household reports that they use any form of contraception, this dummy takes the value of 1. And it seems that average contraception seems to be higher with exposure to the policy, right? So it seems to be higher across specifications, right? With this intervention. All right. This is the result on fertility. Whether the household is currently, whether the woman is currently pregnant or not, this seems to be lower, again, on average, right? So the average effect, intent to treat, it seems that pregnancy currently seems to be lower with exposure to the policy. But I'll show you more granular results with contraception usage to get a better sense of what this policy is actually doing, right? So this is more like composition of contraceptive choice, right? So if you look at this, we find something apparently counterintuitive, but actually very interesting, right? So you'll see that the usage of OCPs or ECPs or condoms are actually going down, right? But alternate forms of contraception seems to have gone up. So the average effect that we find, the average increase in contraception usage that we find seems to be driven by alternative methods. So it's possible that the information channel is working, but because now these contraceptions are priced, you would expect some sort of substitution effect. Now you would say that, well, you know, these are very marginally priced, right? It's just priced at 1. But again, there's this huge literature in behavioral economics particularly, which says that, you know, any marginal increase is not the same as an increase from 0 to 1. The moment you go from free towards any price, you know, the disutility associated with paying the price is much higher. So we think that something like that might be at play here, that because now these are priced, previously you could have gotten it free of cost, there would be a tendency to substitute away. But because there's this information nudge associated with it as well, right? This seems to lead to an increase in overall contraception. So what types of contraception are going up? It's mostly, you know, traditional forms such as withdrawal or abstinence, or, you know, more permanent forms of contraception such as sterilization, right? So we think that it's like a shift from, you know, a low variable cost sort of method to, you know, a high fixed cost but zero variable cost method. If we think that there's a strong preference for the zero cost, you'd probably move towards a zero variable cost sort of contraception method, moving away, even though you may have to incur a high fixed cost for that. We have more on fertility patterns and usage patterns and fertility preferences. I think I'll just have time to show this one perhaps. So we wanted to check if this leads to a change in fertility preferences. We do find that, yes, there seems to be a decline in the perception of the ideal number of children that the woman wants to have. However, there's no gender preference there. So we do not find that there's a change per se in son preference or ideal number of daughters, but they do want to have fewer of both, but these are imprecisely estimated. But we find some precision in the total number of children that they're planning to have. Okay, I have a bunch of robustness. Now I'll pick my favorites perhaps, given the interest of time. And if you wanted to see something else, I'll be happy to show you. I'll show you one here, which is random simulation of treatment status. So instead of using the actual definition of the intervention, instead of using the actual 233 districts, what we do here is we randomly select 233 districts, right? So we preserve the distribution, but we randomly select 233 districts to be treated. And then we simulate the regression and we run it like 1,000 times and we plot all these coefficients. So you'll see, of course, everything is centered around 0. And the actual point estimate where we use the true definition, these are very much at the tail of the distribution. So it seems that it's not something spurious that we are perhaps picking out, right? There's something else I wanted to show. Okay, I wanted to show you something with including a control for a joint family. because we were concerned that, home delivery when an Asha, because, the Indian society has a lot of taboo associated with it as well. So, if you're living in a joint family, it might matter whether, when an Asha worker is coming to give you some kind of counseling, right? And if your parents-in-law are right next to you, whether you'd be comfortable having this conversation or so on and so forth. So we wanted to throw in a control whether you live in a joint family versus where you're not living with your parents-in-law, but we do not think that the results change, as you can see here. We tried a couple of other things. I'll show you one more, perhaps. Maybe by marriage. Yeah, so we control for the age of marriage. We also control for years of marriage, because again, there are different norms in different states of India where, the average ages of marriage are very different. So there were concerns that we had that, perhaps that may have to do with the usage, because we are looking at a very specific age category of women, but that actually does not have an impact on the overall findings that we have. All right, so very quickly, let me move to the conclusions, and then I'll be happy to take questions. So we find that the policy, on average, increased contraception usage among households and lowered the fertility rates. This is suggestive evidence that fertility preferences of women have also been impacted by the policy. Now, households seem to respond to the price shock, even though it's a very small price shock, but they seem to respond to this price shock by substituting away towards alternate forms of contraception. And these alternate forms are actually traditional methods, which are costless, or permanent methods, which have high one-time expense, but zero variable cost for the future. So there seems to be a strong preference, or we think that this is a revealed preference for, costless contraception in some ways. Thank you.
Thank you. Yeah, so the floor is open for any questions or comments.
I have two. You may have looked into this. Was there any simultaneous push for permanent methods at the same time?
We look at that, but it's not varying by the exact treatment status. So it's not varying by the districts that we look at. Right?
Okay. And
so
I
at least that will not be a confounder per se in the estimate.
Okay, and I found the results on the kind of the type of contraceptive they use very interesting, and also your explanation that an increase from 0 to something is very different from the same marginal increase. So I was just wondering if it would merit some of your attention that you think of just the post periods, the 2 post periods, because now we are moving from a period, both periods are priced.
Right.
But if the nominal price was the same, the real price has fallen. And then you showed us one graph, but if you disentangle that in those 2 periods, what do you see would be interesting to look at? Okay,
yeah, that makes sense. Yeah, I'll try that. Although I'm not sure how much power we may have, but I'll definitely try. It's worth exploring. And it's a very interesting solution. Thank you.
Thanks. Very interesting paper. Thanks.
I had one question as well. Yeah, it's quite interesting to see the difference in the contraceptives that were taken off were completely different from what was being promoted in the program. So I was wondering that was the impact, because the permanent sterilization went up. So was it the older women who were largely showing the impact, some heterogeneity by age, because I'm sure younger women won't really go for it.
Yes, I mean, that's actually, it's a very good point, and that's what we are currently trying to explore. Whether you have completed your fertility, or if you're closer to have completed your desired fertility, then if there's heterogeneity by that, because you might expect that sterilization might be a more preferred method as opposed to other forms of contraception. But yeah, I think that's what you're suggesting, right? Like to break it down by age, and then.
So if it's the information channel of that's flowing through, but this particular method is likely to be adopted only by older women,
right,
who completed their fertility, who probably had the desired fertility, or is it the younger women too? I'm like, maybe it's the women in late 20s who probably have completed 2 children. Maybe that's a desired fertility now.
Okay.
I think it would be interesting to see either ways. Who are these women, and at what age are they now opting for this permanent kind of a sterilization, or more at least permanent? The other thing I was wondering is that what I've heard anecdotally is that at least in the rural areas, people are quite averse to having pills. They generally have, certain notions about how they may affect their health adversely. I'm not very sure if there is any question in the NFHS or if there's any actual written evidence around it. But just was wondering that if that could play a role in them not taking up the pills, but actually,
Right.
getting the information, but not taking the pills because of some, misinformation or some notions
Right,
about
right.
the possible health impacts.
I
And
think-
hence,
Yeah, this is very interesting. I think IHDS does ask a set of questions on awareness. I don't know if it's about the pill, but definitely about HIV and some of the other things. But maybe we could try looking at it to see if they are generally aware or whether there is any incidence of misinformation. But it would be really nice to explore what you're suggesting.
maybe NFHS does. Like, I've never looked at these
NFHS
questions.
does? All right. Okay.
No, I don't know. Like, I'm just like giving you the
Could be.
options to search. Could be. Given that they have so many questions and I've never looked at these
Right.
areas of questions so deeply. But
Right.
if there is something which can sort of throw more light on why
Right.
they would not,
Right.
one is the price,
Right.
the other could just be misconceptions, I feel.
Right.
Why they would not go up and the other methods, which they're anyways more used to. Now you could look at the existing prevalence, right? If the existing prevalence itself,
Right.
and what's the cost for each? So if you were to take cost of sterilization in a primary health center
Right.
versus say if they were having pills over 10 years.
Right. So the other thing, so while it's interesting, probably my first reaction to this would be that unless we think that these would have differentially affected women in the treated and the non-treated districts, because if there's misinformation, it will be fairly pervasive, perhaps, right? So what we're finding here is that the policy would have to affect the misinformation, perhaps, right?
No, the policy, like in a way, you're giving information about improved benefits of contraception.
I see. Okay. So when the ASHA
Right.
workers
So
are
now
having
you have
conversation,
that information where contraception is useful and I've obtained that information, but at the
Right.
same time, I have this notion that pills are not good.
Right. Got it.
So then what
probably
are the
switch
options
to
I
something
have?
else. Yeah.
Exactly.
Got it. Makes sense. Yeah. I'll definitely try to find more that we can do on this. Thank you.
Yeah, so I might have missed this, but I think you made a really convincing case, right, for both the information and the price treatment and how households are reacting to this. Have you tried looking at distance, right, to the nearest healthcare provider, and whether there's any reaction to the convenience part, right?
Yeah.
Because in some sense, it's kind of surprising, right, that
this is something that we
seems to be
really want to
dominated.
do. And that's one of the reasons why we have not sent this out yet. We're trying to do that, but there's no clear, there's no clear consensus, let's say, on how we should be doing that. We'll probably have to, because we have village codes, and so we'll have to try something. Because ideally, we'd want to know what the actual distance to the nearest PHC would have been, because then it will make more sense of what the counterfactual would have been, right? So, but yes, we are definitely on it, but I don't have anything exciting to tell you as yet.
No, but the results are fascinating.
Thank you.
Just to sort of enter here, like, doesn't IHDS have a village questionnaire which has PHC access for every village? At least whether or not they have PHC inside the village? Like, they don't have the distance.
I'll have to double check on that. Off the top of my head, I don't recall.
Maybe
I
you
think
wanna
the
check,
issue
they
is that
do
we are
have some
using the women
village-
sample, perhaps, and then we'll have to.
They have a village, a separate data set on village.
Yeah, they
At least
do.
they had it for
Yeah.
2004-5, which I've used.
Right.
I'm not very sure if they have it for 11-12,
Okay, I'll definitely.
but for 4-5, definitely they had a village amenities.
Okay.
A data set.
Yeah, if
also
they
for
do, then
2004.
it'll be easy to sort of merge it in, and then we'll take a look at that.
Somdeep, I had since I'm interested in sort of cultural issues, is there any difference by, whether it's as you move towards Eastern India, where the status of women is somewhat better? Is there any difference by that, or is it something worth looking into?
I think it's definitely worth looking into, but we have not tried that. But I will. Yeah. So like geographic heterogeneity.
And also perhaps the disease environment. I mean, if there's an area of high child mortality, would that impact the decision to have children? You know, you might want more spare children, let us say, if in a region of high child mortality.
Right. Okay. So you're saying that the preferences for the number of children you want to have could be correlated with the disease environment. Is that what you're saying?
Yes.
All right. Okay, I'll need to think more on that. Yeah, I'll have to think of a way to look at that. But I'm guessing that since there's within state variation across districts, so but it's still possible. It's still possible. I'll explore this further. Anything else?
Any
All right,
other?
thank you. Thanks a lot. Really
That's
appreciate
really-
the feedback.
Oh yeah, very fascinating. So yeah, then let me start sharing my screen as the last person here to go up. And so we're now coming full circle, going back to issues very much related to what Deepti was talking about in terms of NREGA service provision and how maybe we could get implementation quality up. But we're looking at it from a bit of a different lens. And so we're still revising currently the version. And so we've just decided on a new title here. So de jure versus de facto transparency is our main selling point. But so yeah, questions and comments very much welcome as we're sort of figuring out how to better maybe make our case here. But yeah, so what we're starting with is probably doesn't need that much motivation, but the idea that corruption incurs very high costs. So there's some quotes here that maybe 1/5 of rice distributed for an anti-poverty program in Indonesia had just disappeared, or that really corruption is estimated to increase the cost of achieving the UN Millennium Development Goal on water and sanitation by $48 billion. Right? So these are typically non-negligible additional costs incurred that harm sort of the outcomes they're supposed to improve. And the most common policy suggestion by both policymakers as well as researchers tends to be this idea that, well, to reduce or even eradicate corruption, what we need to do is strengthen transparency mechanisms and accountability mechanisms, right? So the idea is that citizens, for example, stakeholders, need to have information on where the power is being misused, because it's really hard to do anything about it if you don't know what's happening. And then they need to have the ability to actually hold the corrupt official or politician or whoever it might be accountable for their actions. Now, the implicit assumption in this is that citizens actually have the necessary tools to access whatever information you give them. And then once they have that information, also have the desire to actually punish the person who's corrupt. And what we are arguing is that it's not automatically clear that transparency interventions and accountability mechanisms automatically satisfy these assumptions. So this is what we mean between de jure transparency, where, for example, theoretically, for NREGA, as I'm sure you pretty much all of us know here, there's a publicly available website, right? So theoretically, there's a wealth of information out there at people's fingertips. But de facto, the question is, do people have access to the internet, for example, to get to that web page? Do they know how to use it? And if they don't, right, there might be obstacles to achieving true transparency that are not captured by sort of more superficial treatments of de jure transparency. And so what we're doing is investigating those assumptions by studying village council presidents or pradhans in Uttarakhand and how they implement this NREGA program. The idea is NREGA really allocates a key role to pradhans to make de facto decisions about who gets employment in the village and how much. And because a lot of them, so for Uttarakhand, the coverage we'll have is about 90% of Uttarakhandi households actually show up in the NREGA database. So we have a lot of these local politicians who directly show up on their own NREGA job profiles as well. So what we can do is sort of merge the two and take a look at what happens to self-dealing? So do pradhans give their own households disproportionately many jobs? So that will be our measure of corruption. Now, it's of course clear that this is not technically illegal. So if you have a true need for the program, there's really no law suggesting that pradhans should not give themselves or their households employment. But especially if you give yourself disproportionately much employment relative to everyone else in the village, this seems unethical and certainly meets the most common definition of corruption as sort of the misuse of public office for your own private gain. Yeah, the other thing that's interesting about the NREGA program is that it has an unusually high level of transparency. You have this publicly available website, which you can drill down on down to the village level. You can look people up by name. And so it's gone a lot further than a lot of other interventions have within India, in other countries, in an effort to curb corruption. Now, as a brief preview here, so we're actually going to scrape two data sources. So number one, the local election outcomes for the 2014 Uttarakhand local elections, panchayat elections, and then we're matching that information to the job allocations of candidates and typical villagers in the NREGA database. So we've pretty much scraped all of that information from the official website. As I mentioned, we have really good coverage, estimated about 90% of households appear in the NREGA database. We can do a crosswalk, and that gives us our data of interest. Now, of course, if we just were to run that regression, there'd be a concern that the job allocations for winners and losers of these panchayat elections could just be due to differences systematically, right, based on reasons other than corrupt self-dealing, right? So maybe winners are systematically different than losers, right? Systematically richer, more connected, and so on. So we'll do I feel like the typical political economy trick of focusing in on close elections, which in our case, since these are very small villages for the most part, are also really close. So we're looking at 15 votes. And so the idea is that this will give us close regression RD and sort of comparable candidates that just won or just lost their race to become pradhan. This, of course, by design excludes villages with low accountability to voters, right? So where politicians might win by a landslide. So if anything, we should also have a very strong accountability mechanism compared to other contexts. Yeah, this is just to give you a sense of what the website looks like. Many of you might have seen this yourself at some point, but you can actually go and look at these job card profiles, right? And so I've pulled those up for actually one of the cases that's in our actual data set. So we have here a very competitive election where the household of the candidate on the left here won by 3 votes. Candidates on the right lost by the same 3 votes, became the runner-up. And if we compare sort of the information we can glean from the job card profile, things like number of adult household members, their ages, gender composition, caste status, and so on, they look really, really comparable. And so when you scroll down then, so this is the top part of the website, if you scroll down and you look at the job spells under the NREGA program, you find that the winner here has a long list of NREGA projects that household members worked on. And this is actually, we truncated this, so it was actually a much longer list here, whereas the loser, you can see here, is completely empty. And so it's maybe a more extreme case than we'll see in the actual data, but sort of suggests that there might be substantial self-dealing, even though theoretically everyone can go to the website and very quickly pull up the same information that we have here. Now, after we'll find sort of substantial self-dealing, the question will be, well, why is that happening, right, despite sort of unusually high transparency and accountability mechanisms that are already in place? And this is where we'll turn to 3 assumptions. So one, access to infrastructure, especially internet access in our case, right? So do the effects in terms of corruption, do the results differ, right, by whether you're likely to have internet access or not? then we might be thinking about, is the information available in a timely manner? So even if you have internet access, you might never go to the NREGA public website if there's really no useful information for you on there. Right? And so the main reason why the typical worker or other stakeholders like local media might check, NGOs might check the website, a lot of times relates to wage payments. Right? So Deepti was talking about this earlier, right? But as reforms to NREGA have come in, they've tried to automate a lot of this process and directly have the central government pay the NREGA wages into beneficiaries' bank accounts without going through state or Gram Panchayat accounts. And that means that the website is really your main source of checking where they are in the process and whether that money has been paid in, unless you go to the bank branch in person to check. And so the concern is that in Uttarakhand, there were massive delays to updating the website on the order of 30 days, wage payment delays on average of 74 days with very high variance in between. So the concern is, well, maybe the information available in a timely manner assumption, and therefore the attractiveness of the website is just too low to really have an effect. And then lastly, there would be the question of, well, maybe people know about this, but there's no desire to punish corruption. And so specifically, I think a story you often hear, and one actually that the Pradhans told us themselves when we did a phone survey with about 200 of them, was that there might be sort of performance pay, implicit or explicit arrangements where NREGA is a pain to implement. You have to come up with these projects, you need to get them approved, you need to monitor the employment and so on. And so maybe Pradhan's only willing to do this if there is the understanding that out of every project that gets provided, for example, they get a certain percent of employment as well. Right? And in that case, you might almost think of corruption as sort of a second best outcome, and that might explain why it persists. Yes, a bit of background, which maybe none of us really need in here, but Uttarakhand, of course, small state, about 10 million people, 86% of the area in sort of those mountainous regions, which is actually something that will be important for us because it gives us variation in the strength of internet access, which is highly related to altitude and changes here. I think I can skip the rest here. Again, we're probably all heard a lot about NREGA, but yeah, massive public works program, supposed to be this guarantee. In practice, the Pradhans have a lot of power in Uttarakhand as well as elsewhere to decide how to ration jobs because there's excess demand to specific individuals, and therefore can also determine, yeah, whether they give their own household a lot of employment relative to others. So I'll skip this probably as well. Yeah, and so really we have, I would think of roughly 2 phases, maybe 3 if we're being really precise about it. So really when we're looking at the 2014 national election, sorry, not national election, 2013 Uttarakhand Panchayat election, this was a time when Uttarakhand had not actually yet implemented the e-FMS reform that Deepti was talking about earlier. So at that point, you had the website, you had some safeguards in place that were supposed to reduce corruption. So automatic flags in this NREGA software that was supposed to flag cost explosions, or then increasingly having sort of the links of job cards with Aadhaar numbers to sort of improve identification and reduce the likelihood that ghost worker accounts would be registered. But this was before you had a direct payment into beneficiary bank accounts. Now, in the year or 2 after our Pradhans get elected, Uttarakhand adopts the e-FMS reform, although as I show you, we'll really see no difference in how that seems to affect our estimates. So certainly in Uttarakhand, it doesn't look like e-FMS had a lot of bite. And partly as a response to that, the national government actually pushed through the next reform, which was the national e-FMS reform, which was supposed to be an improvement that would further shorten wage delays, wage payment delays. And so this is the reform that comes in mid-2016 that we'll then be using for our test. In terms of research design, as I said, we'll do a close regression RD, looking at the top 2 candidates, sort of winner and closest runner-up. Really doesn't matter whether we look at our running variable in levels, so votes received versus the vote margin. Our results are really, really robust, but we do both. We use sort of the Kanika et al. Seminal paper to guide our bandwidth choice, but again, lots of robustness to different bandwidth. And then we check robustness in a lot of other ways, clustering standard errors by Panchayat. And so this is sort of the first main result, which I guess is on the right side here, suggesting that in areas where the candidate just won the election compared to the candidates or the households that just lost the election, we have this big discontinuity here. And so winners of these close elections receive 3 times as much labor under this NREGA program as close losers of the same races. And so given that the pradhans make those allocation decisions de facto, right, this is clear evidence of self-dealing. If you're wondering, well, how does the typical loser household here compare to the typical household in the village? And we find actually that the losers here get about the same amount of NREGA work as anyone else in the village. So it's not like the loser is being penalized by the winner, but it's really just that the winner household gives themselves more labor than anyone else in the village receives. Now, this is an example of a placebo test, and so this is before the election, just to show you there's nothing going on there at baseline before this election took place. Okay, as I mentioned, yeah, we can do a lot with robustness. We can look at, this was NREGA days, we can look at number of jobs, we can do extensive margin, we can look at earnings. You find very much similar results. And the results hold when we restrict just to villages where we can match both the winner and the loser. So occasionally one of the two is in the database and the other is not. But go through if we just restrict the sample to areas where we can really match both winners and losers. Doesn't matter what we do with the running variable. And as I mentioned, not due to the punishment of the loser by the winner. We can also do a lot of placebo tests at baseline where really we don't see any discontinuities that would look suspicious. It's also not systematically easier to match winners in the job card data than losers, which would be another reason to be concerned. And yeah, lots of robustness across bandwidth choices. So then the part that we find actually most interesting is then the question of why is this happening? If theoretically everyone can check what is it that that leads to the self-dealing to persist. And really we might think that there's 3 potential mechanisms. So one is sort of this internet access. So local stakeholders such as voters or then anyone else who would hold politicians accountable, such as NGOs or the media, must have the ability to actually access the website, right, to get that information. There might be the concern about the timeliness. So if information is posted with a long delay, the incentive for people to go and keep checking is going to go down, especially because we assume, and there's a couple of anecdotes suggesting that that's true, that people mostly go to the website first to check on their own regular employment. And then what they see very clearly is that the projects are hyperlinked. So typically in your own job card profile, you have for every employment spell, this is the number of days you worked, this is the wages you got paid and so on. But then you also are provided with a hyperlink of the project you worked on. And if you click on that, you'll then find a list of everyone else who worked on the project, again with hyperlinks to their job card profiles. And so with just 2 clicks, you can actually go from your own profile to then looking at what other people received, which is probably the most common case in which people realize, oh, there seems to be a substantial imbalance here in terms of allocations. Yeah, so that's the second assumption. Then there's sort of the question of, is there even a desire for punishment or accountability, or is this an incentive scheme of some sort? And really, there's reason to believe that in Uttarakhand, in our survey period, there's concerns with all three. So internet access and actually cellular data networks too, far from standard in many rural areas in Uttarakhand. Actually, in the paper, we have a pretty stark picture of cellular data networks from as recent as 2018, where it's very, very clear where the border is to Uttar Pradesh, where you have really good coverage throughout. And then in Uttarakhand, even at a highly localized level, some areas will get really good signal and others have de facto no signal whatsoever. Same thing is true with internet access, and we'll actually be using a proxy from the 2011 census about distance to the nearest cyber cafe as sort of a proxy for internet access to the NREGA website. So we'll be doing sort of a difference in the discontinuities approach. So think of the treatment versus control as, do you have internet, do you have at least lower distance, I should say, to the nearest cyber cafe, or are you very far from the nearest cyber cafe? So de facto might have a hard time having access to the internet. Then the concern about, yes, the lagging behind on the implementation part is where we then use the policy dimension. So again, in mid-2016, this e-FMS policy reform comes in that tries to actually reduce wage payment delays and therefore increase the attractiveness of the website. But that means beforehand, before 2016, maybe the timeliness was so much of an issue that this was an assumption that failed. And then we'll actually construct a measure of performance, which is sort of employment provided to everyone else in the village, to observe whether there's a strong correlation, as you would expect under performance pay, between sort of the self-dealing and then the employment you're providing to everyone else in the village. Okay, I've said this. And so maybe I'll go to this headline first, which is the true difference in discontinuities approach. So what we have up here is the self-dealing. And so this is a baseline before any of the politicians actually have the election. Just to show you, there's no pre-trends of any sort going on. Then between 2014 and 2016, these local politicians are in office, but this is when the e-FMS policy gets adopted, right? And as you can see, really, we don't find any statistically significant effect that this had on self-dealing, or for that matter, no real big change here apparent on the performance. So it doesn't look like e-FMS in Uttarakhand, at least, led to a large improvement in number of jobs created or to a reduction in the self-dealing. But then what we see happening after 2016 is sort of this decline in self-dealing, while there's no real effect on performance, stays very much at similar levels to what it was before this policy. And so if we look at where's this decline here coming from in the individual treatment versus control places, so these are the far away cyber cafe areas with poor internet access, at least based on our proxy, versus these are the areas with closer access. You can see entirely the reduction self-dealing is driven by corruption going down in the close to the cyber cafe areas, whereas self-dealing actually remains pretty much unchanged, except for this blip here, maybe in 2017, in the faraway places. Yeah, and so to conclude here, what we're finding is that there seems to be a big difference between de jure and de facto transparency, even in a case like NREGA, where substantial care and many policy changes over the years have gone into strengthening sort of the availability in real time of information and sort of the accountability mechanisms, right? Think about social audits, think about sort of other ways of holding local politicians accountable through elections. And so our results suggest that corruption in our context persisted because many villagers couldn't access the online system, didn't have internet access, in combination then with the problem that the information was not timely. So the variance, I think, on wage delays in Uttarakhand was between 1 day and 669 days. And so after you've waited for a couple of months or weeks for your NREGA payment, maybe not too surprising that you maybe don't go back to the website that often to check whether there have been any updates. On the other hand, we don't find really any evidence to suggest that corruption here forms a second best solution as some kind of a carrot in a performance pay scheme. And so to us, this suggests that policies need to be really carefully designed and where they need to be adapted to the specific context of what the true obstacles are that would stand between de jure transparency turn into de facto transparency. We have a number of papers actually in the literature that have found very mixed evidence of these transparency interventions. So some papers find massive effects, others find almost no difference. And so this sort of discrepancy between de jure and de facto transparency might be the reason why. And with that, I'll stop here and looking forward to any questions or comments.
I have a question.
Yeah, definitely.
So I think I didn't understand that part fully. So when you're matching, so to understand whether the household got transfers through, through either employment or wage payments, you have the name of the village pradhan. Do you also have the name of the family members of the village pradhan?
Yeah, that's a great question. So what we have, certainly from the election results, is the name of the village pradhan, and then we have the name of the closest male relative, which is something we also have in the NGNREGS database. And so that really helps us be sure, or surer, we should say, that that we're matching the correct person, because we can match on both the name of the politician as well as the closest male relative. Now in the elections database, we don't have, of course, any kind of relatives, but in the NGNREGS database we do. So we've also looked at some point at, well, who in the household actually works on these NGNREGS projects, right? Is it the pradhan themselves, or is it someone else, right, who might be living in the household? Not quite sure. We've cut it out of the paper again. We're not quite sure sometimes how to interpret this, because it's not quite clear that there's any actual work going on, right? So it's not quite clear that the pradhan would actually work on these projects. Seems more likely that they're just writing in their name and then getting the payment without doing the work. But we've not found like a clear pattern of whether, say, the politician themselves or their spouse takes this up. The other thing that we've tried at some point is looking at extended family. So maybe it's not your own household, or not just your own household that gets extra work, but also your broader network. We don't find, actually surprisingly, maybe evidence that that's the case. We also don't find differences on reservation status. So it's not the case that male politicians seem to be different from seats that are reserved for women. We don't find actually statistically significant differences by caste either.
And in Uttarakhand, if I understand the context, like that's definitely a state where there's very high male migration.
Mm-hmm.
Probably it has one of the highest male migration in India, because there are not many employment opportunities available in the hills. So what's the average fraction of women? Or like so my hunch is that there would be more women on average in Uttarakhand than as NGNREGS workers.
Yeah, that's a good.
And does that have any implication? When you have, just in terms of not being aware or not having used digital technology too much, because male migration rates are like almost 10 to 20% in many villages of Uttarakhand, maybe higher in like those which are more remote. So averages between that. So, I'm just wondering if that has something to do with probably less awareness or less use of digital technology, even when available. I don't know how one can use that for anything, but just a thought there.
No, that's really interesting. That's really interesting. I don't think we've done that specifically. We've mostly collapsed days of work to the household kind of thing, but you're right, it could be interesting to look at that a bit more cleanly. What we've certainly done is try to look a bit at the migration channel, and is this a reason to be worried? Are there going to be changes in migration that coincided, right, with this policy? and we don't have perfect migration data, unfortunately, as usual, to look at this, but we've controlled for a number of other things, like if remoteness is the issue, right? You could imagine controlling for the nearest city. We've done a lot of that, controlled for things like literacy, for a lot of other sort of village amenities, distance to the nearest bank that you can get from the census, and all of these we really don't find don't matter. So district to the headquarter, district to the nearest marketplace doesn't matter. And so to the extent that that might partially at least control for the migration, it doesn't seem to be a threat. But what you're suggesting is interesting. I don't think we've looked at, could the awareness differentials come from who actually works on NREGA? That's really interesting. We'll definitely do that.
I have an alternative. I don't know how credible it is, but let's say the Pradhan, his objective is to get the work done efficiently.
Mm-hmm.
And let's say that he can prevail upon his relatives to work hard as opposed to strangers. I'm just wondering if that might be something, so he's actually, his intentions are good, but he can only trust his own people.
Yeah, excellent question. This is actually something that the Pradhan sort of told us when we did the phone survey. It's like, oh yeah, it's a lot of work. We need to keep these going. And again, we don't have the perfect way of looking at this, but we've tried to look at things like seasonality, right? So there's of course a lot more excess demand during the agricultural off season. So there you might have, I don't know, fewer problems incentivizing people to work hard than maybe during other months. Don't find much evidence that there's seasonality in this. Certainly there's no seasonality in the Pradhan work, which maybe hints at, again, that this is not related to need, but to something else. But we don't have, I think, as perfect of a way of ruling out your alternative story as we would like. But yeah, maybe we can think more about how to rule this out. At some point, we've looked at also who enters the data. And so again, if we think that under the corruption story, where they do this without anyone knowing, ideally, you might be concerned that if there's other people who enter the data, which is mostly the case, that would provide a bit more accountability or monitoring than in areas where your relative, for example, holds the position and enters the data de facto. To the extent that we've been able to collect that data, it doesn't look like typically you have friends or relatives who are in that position of power. But again, not to suggest that's not happening. So yeah.
But if it's what Gautam is suggesting, that it's to incentivize or get work done more efficiently, why should it change with information? Then, so you have that going as an explanation.
Yeah.
And I along those lines, I understand why you look at close winners and losers, but suppose it is this information availability, quick information availability that's driving this, then one would think that maybe even for the places where the margins were high, this may still play out. So just as a descriptive, you may want to see if that's happening.
Yeah, that's a good idea. We haven't done that, but yeah, you're right. It'd be interesting to see what happens off the close election path. Related to the why would, under Gautam's story, why would that change with the policy? I think the alternative story that we've heard about that is, well, is this top-down monitoring, right? So you clearly have the national government step in and say, well, the e-FMS didn't work, so we now need the e-FMS. So maybe now they care and they want this to be a success, and so they look more closely at what are actually our people doing. Now then, though, you'd think that, well, for the national government or even for say the district or the block level administration, if they check up on the Pradhans more, that really should not necessarily differentially vary by internet access, because presumably the district headquarter, certainly if we go higher up, does not have the same variation in internet access that we might have locally. So it doesn't seem quite obvious why people would be concerned about top-down monitoring in some villages, but not in others. But again, we don't have maybe the perfect silver bullet to rule out these alternative stories.
And is there a difference by female, by the gender of the Mahajan, of the village head or whatever?
Yeah, surprisingly not. So we've looked at this by reservation status, and we don't find anything coming even close to statistical significance, and the coefficients look very, very similar to one another. Yeah, no, thank you so much for that feedback and for an amazing session. I think we're pretty much perfectly on time here. So this was an amazing session, a lot of fun. And I guess the day in India is just starting. So I hope you all have a great weekend. And I guess we're about to go to bed here in the US. And hopefully we'll be able to see each other again very soon.
Yeah, thanks for organizing this. Thank you.
Yeah, definitely. My pleasure.
Thanks, Laura.
Bye.
Thanks, everyone.